All right, let's just dive right into the wild market action we saw on July 23rd, 2026. What we're looking at here is a highly unusual synchronized drop in both big tech and semiconductors. Normally, we expect sectors to take turns, right? Capital rotates from one to the other, but right now, they're plummeting together. This sets up this crazy domino effect where massive macroeconomic headwinds are crashing straight into micro-level corporate earnings. So today, we're going to unpack exactly what is driving this sell-off and what it means for the broader market.
So here's our roadmap for this explainer. We're going to cover the tech and semi sell-off, oil spikes and rate fears, Intel's fading earnings pop, defense stocks and geopolitics, Google's AI capex warning, and finally, those key market support levels.
All right, first up, the tech and semi sell-off.
You know, market dynamics usually act kind of like a seesaw, right? Capital rotates between sectors as investors trying to balance out their risk. But lately, it's like that seesaw just snapped in half. The real anomaly here is the co-movement. We just haven't seen big tech and semis drop together like this in quite some time. I mean, out of the entire Philadelphia Semiconductor Index, only 20 stocks actually went up, and that was mostly just a handful of memory chip guys. The rest just absolutely hammered. And here's the crazy part. Despite all this widespread selling, the VIX, the volatility index, was just hovering right around 18. It didn't spike above 20 or 22, so we aren't seeing sheer blind panic yet, but there is absolutely a unified risk-off mood sweeping the market. So the big question is, what exactly triggered this sudden unified dumping of shares? Well, that brings us to part 2, oil spikes and rate fears.
Honestly, the market got completely blindsided by some massive macro triggers. Let's look at the timeline of events, because it perfectly captures just how fast the geopolitical situation in the Middle East is escalating. A few days ago, we had Houthi attacks on Saudi tankers in the Red Sea. The U.S. responded by deploying B-1 bombers for strikes on Iran, which, by the way, is the first time since the conflict restarted. Over the last 12 days, those strikes have just kept coming, and recently, Iran flat-out rejected a proposed 10-day ceasefire. The immediate fallout? Brent crude oil violently spiked past the $100 mark, peaking somewhere around 102. The market had been cruising along pricing oil at like $90, so this sudden jolt, it's forcing a massive across-the-board recalculation.
And throwing gasoline on that fire is the shockingly strong U.S. labor market. Just look at these jobless claims. Initial claims plunged to 187,000. Wall Street was expecting 212,000. So we're talking decades-low levels here. Continuing claims also beat expectations, coming in at 1.796 million. Now, normally, a strong labor market is great news. But right now, it's a huge headache for inflation fears. When you combine surging oil prices with a red-hot labor market, you get inflation that is incredibly sticky, and that pretty much glues down expectations for tighter monetary policy from the Federal Reserve.
And here's the immediate, brutal fallout from all that anxiety. The 10-year Treasury yield absolutely surged to 4.697%. It just blew right past the resistance levels we saw only 2 months prior. Guys, this is a massive headwind for the stock market. When risk-free yields climb this high, it throws an incredibly heavy blanket over the valuations of growth and technology stocks. If speculators push this yield closer to that psychological 5% barrier, we're looking at some serious trouble for equity valuations.
Moving on to Section 3, Intel's fading earnings pop.
So with all these macro winds blowing in our faces, let's zoom in on the micro level and see how individual companies are holding up. On paper, Intel actually delivered a killer Q2. Revenue came in at $16.1 billion, completely crushing the $14.42 billion estimate. Earnings per share literally doubled what Wall Street expected, hitting 42 cents instead of 21. A huge driver here was their foundry business, which was up 31% year over year to $5.8 billion. Plus, their forward guidance was surprisingly solid. So naturally, at first glance, the market loved it.
But here's where it ties right back into our broader market story. Right out of the gate in after-hours trading, Intel's stock rocketed up 13%, huge spike. But in this current risk-off climate, those buyers vanished almost instantly. The stock gave up those gains incredibly fast, fading all the way down to a measly 3% settled gain. This right here is textbook speculative exhaustion. Investors are so skittish about the macro risks we just talked about that they're using any positive earnings pop as a quick exit strategy to just sell and take profits.
And when you glance at Intel's technicals, you totally get why they're scared. With the stock hovering around $100, its forward PE ratio for 2027 is sitting at a really steep 66.6 times. Meanwhile, its 200-day moving average is way down at $65. There's practically no foundational floor beneath its current price. If this broader market pullback really accelerates, high flyers like Intel with these massive valuation premiums, they have a terrifyingly long way to fall.
Okay, Section 4, Defense Stocks and Geopolitics.
Now, you might naturally think, hey, escalating global conflicts, that's got to mean instant, massive profits for defense contractors, right? Well, looking at Lockheed Martin, it's actually a lot more complicated. They just reported this mind-boggling, record-breaking $230 billion backlog in orders. To put that into perspective, back at the end of 2018, that number was only around $186 billion. They also beat Wall Street's expectations for both earnings per share and total sales, and the stock popped 10%. But a giant backlog doesn't tell the whole story.
Here's the catch. Defense contracts aren't just handed over overnight. There are massive legislative traffic jams happening right now. As we speak, there's an $87.6 billion supplemental budget request sitting there, with $67.1 billion of that earmarked for defense. Yeah, the House managed to pass a $95 billion budget blueprint, but they scraped by on the absolute thinnest of margins, 216 to 214 votes. The real roadblock, though, is the Senate. You've got unanimous Democratic opposition mixed with growing Republican skepticism about funding foreign wars, creating severe uncertainty. Until Washington can clear these divided political hurdles, defense companies can't actually realize those extra profits. So even though they look great on paper, defense stocks are going to require a ton of patience from investors.
Let's pivot to Section 5, Google's AI capex warning. All right, let's talk about the absolute biggest story in big tech earnings right now, because this is acting like a huge canary in the coal mine for the entire AI industry. For the first time in Google's entire history, their free cash flow has turned negative. Literally historic. Why did it happen? Because they've gone completely all in, ramping up the capital expenditures by $15 billion just to fund AI infrastructure. Basically, they are borrowing money in a high interest rate environment to fuel this AI arms race. Ironically, the semiconductor guys were actually bummed it wasn't more. But for the broader market, watching a cash machine like Google burn through money like this is a massive red flag.
Check out Google's critical technical support levels here. Because their core search business is still printing money, they do have a solid midpoint support right around 358. But if the selling pressure doesn't let up, the absolute must-hold line in the sand is the 2027 low support, sitting near 297 or 298. If they crack below that level, the next safety net isn't until way down at 257. And listen, if Google falls that hard, it's basically going to act like an anchor, dragging down the rest of the major tech components and, by extension, the broader S&P 500.
Which brings us to our final section, number 6, key market support levels.
So where exactly are the safety nets for the major indices if this sell-off keeps rolling? Let's take a look at the SPY, the S&P 500 ETF. Right now, it's hanging around 738. The absolute critical warning break level is 727. If the SPY crashes through 727, the whole technical picture flips from a harmless little dip to a legitimate retreat. Breaking 727 opens the trapdoor for a quick slide down toward its 200-day moving average at 695. That would be roughly a 5% haircut from current levels.
And over in the tech-heavy NASDAQ, the QQQ ETF still has to bleed about 7% before it hits its own 200-day moving average. The semiconductor ETF, the SOXX, did recently test its initial support at 532, but, and this is a big but, if the S&P 500 starts breaking down, the semis have room to easily plummet another 9 to 10%. Now, I want to be super clear about this. A 5 to 10% pullback in the stock market, totally normal. It happens on average 3 to 5 times every single year. It's a healthy correction, not a crash. But you absolutely need to be mentally prepared for it. And that leaves us with the ultimate question for 2026. Right now, the entire market, I'm talking capital, debt, human resources, the whole shebang, is betting the farm on artificial intelligence. The survival of this mega stock market rally hinges entirely on one single thing: rapid monetization. Can these companies actually figure out how to make real money off AI fast enough to justify the astronomical piles of cash they're burning today? If they pull it off, as cash flows recover in 2027 and 2028, the upside is practically limitless. But if they don't, well, the market has a very long way to fall. It is the ultimate high-stakes bet, and we are going to be watching every single step of the way. That's all for this explainer. Thanks so much for hanging out with me, and I'll catch you on the next one.